Welcome to the Daily Briefing. It is Friday, June 4th. I'm joined by my colleague in crime, Max Wiethe. Max, how you doing?
I'm doing well, Jack. Colleague in chart crime.
Yeah, well, colleague in chart crime. You know, Max, I always like to say that today's chart crime is tomorrow's, basically the visionary paradigm that people are using. I think John Maynard Keynes was accused by a few people of chart crime when he said that raising rates during the Great Depression was bad. But anyway, Max, we had a pretty crazy week, the beginning of meme stock mania that started the week on Tuesday. And yet today we end the week where stock market is pretty close to all-time highs and the VIX is pretty close to pre-pandemic lows. How are you making sense of this market?
Well, as far as like the VIX being at pre-pandemic lows, that was like the main thing that struck out to me. I just look at that, the VIX at all-time lows, or not all-time lows, but recent lows with you got a Fed meeting in mid-June, you've got CPI print coming out next week. That just looks interesting and attractive to me. I mean, I'm not saying buy calls on the VIX, but whatever your sort of volatility play is, I think that looks attractive. I don't have a very solid view on equity markets either way. I think it's pretty much a choppy market, but with volatility at those levels, I think that looks attractive.
Max, one thing we definitely should talk about is the release of the non-farm payrolls. There weren't as many jobs added as people thought. In fact, I think we have a few charts. The unemployment rate was 5.8, and people thought it was going to be 5.9. So we have this unemployment rate here. And then with regards to non-farm payrolls, it was a miss by about 100,000. So when I look at the number of jobs that were added, the most were in leisure and hospitality, which is good because of services. But what's interesting, Max, is I was reading Ed's credit write-downs today, and he said that it was sort of a Goldilocks moment, a typical example of the good news is bad news, or excuse me, bad news is good news, because labor market missed, that's obviously bad news for the economy. But what it means is that the Fed can keep its foot on the gas pedal and keep on buying QE until, who knows. So what I noticed, Max, is the bond market rally, which we have here. We started the day at about 1.64 on the 10-year, and we had a pretty dramatic drop to 1.56. So dramatic that if you actually look at a one-year chart, you can really see it on a one-year chart, which tells me it was a big move. So what are you making of the labor markets? Does that mean it to you? Is it a signal? Is it noise? How are you making sense of this?
I mean, I just look at unemployment as being very important for the sort of dual mandate of the Fed and the idea that it's not just about price stability, which is like the inflation portion of it, but maintaining full employment, which is not a 0% unemployment rate, but what they determine to be full employment, and that they basically are not going to step off of the gas until they achieve both of those mandates. And so that's getting inflation to the level that they want, which I interpret to mean actually more than just getting it to the level, but also making up for lost time, which could be years. I think if we were to run inflation at like 3% or something like that, it would take like 5 years to make up for what we've lost since the great financial crisis. And then on top of that, unemployment, recovering from an employment perspective is going to be probably a lot slower. And so I'm pretty dovish.
Yeah. And Max, you described for people the Fed being dovish. How do you think that's going to impact assets going forward?
Well, I think they get the inflation and they don't raise rates. And that means lower, more negative reals. And that is making gold look relatively attractive to me at these levels. And then I also, believe in the Bitcoin rotation into gold. I think it definitely stole the spotlight a little bit, and I mean it's not that I'm saying that Bitcoin is going to crash right here and that gold is going to like remain is going to take its place as the true sort of like anti-fiat or anything like that, but it's not going up 20% a week. And there is certainly a group of people who are attracted to the asset for that reason. And if it's not going up at 20% a week and it's still relatively volatile compared to other anti-fiats, I think that makes gold more attractive, especially as I think we will see some inflation and we will not see the Fed try to fight it.
Yeah, during the momentous rise in Bitcoin, a lot of people made the argument that Bitcoin was really stealing gold's lunch, because during this unprecedented expansion in the money supply, money base, whatever you want to measure it by, that's when gold should do well. But actually, gold, it made a high above $2,000 in the summer, but it was extremely weak up until about a month or two ago. So now it seems perhaps that the tables are turning from Bitcoin into gold. Max, what do you think about? Of course, when I say Bitcoin eating gold's lunch, I mean as an inflation hedge. If things are going full Weimar, you want to own Bitcoin, not gold. What do you make about Bitcoin's properties as an inflation hedge? And what do you think the catalyst is for this money going from Bitcoin into gold?
I think the catalyst is that it's not going up. I think the main use case for Bitcoin is that the number goes up and to the right. I do not think it has proven itself as an inflation hedge. It has proven itself as a magnet for assets, which is why it has gone up. But we got a surprise CPI hit the other, CPI like 4.1 the other day, and Bitcoin went down. So it didn't perform as this sort of like inflation hedge. Like how can you say that it's an inflation hedge if it's doing that? But I mean, it is certainly a magnet for assets, and that's why it has gone up. But yeah, I mean, that's how I look at it. And arguably, gold has served poorly as an inflation hedge as well. And when I talk about gold, I'm talking about it as how it relates to reals. I didn't say buy gold because we're going to get a CPI number that surprises to the upside. I said we're going to have a dovish Fed, and we're going to have CPI. So it's the combination of the two. And historically, gold has not served as a fantastic inflation hedge in the traditional sense. Hard assets like commodities that are more, I think Michael Cal uses the phrase OPEX and CAPEX commodities that are actually being spent, money being spent and needs to be spent on those commodities. That's where inflation is, and those are better inflation hedges. Now, Luke Groman, he uses this phrase about gold where he's like, it's useless for 99% of the economic cycle, except for when it's very, very useful. And so is this a Weimar like style inflation? Like, I don't think so. And I don't think we're going to achieve that. And so I don't look at gold as the ultimate inflation hedge at this moment in time.
Max, there's a lot there. I would say, how about the fact, though, that gold was a very bad investment to make from 2011 until let's say last year or so, was actually meant that it was a good inflation hedge because we didn't have a lot of inflation. Something like Bitcoin that has had momentous eye-popping gains during a deflationary decade doesn't say to me it's a inflationary hedge. Inflationary hedges perform poorly when there's low inflation. What do you say about that?
I would say that that's a logical fallacy, and it's not about how it doesn't perform in areas where something doesn't happen. It's about how it performs when something does happen. And that's what matters, whether it's an inflation hedge. How it does when something doesn't happen, it doesn't have to be inversely correlated to be in the disinflationary or deflationary environment. It doesn't have to go down, or it going down doesn't make it a good inflation hedge because it underperformed. Like, maybe it's just a bad asset.
Yeah, but Max, like, the ultimate stock hedge is to buy a put on the S&P. If the S&P 500 goes up, the value of the put is going to go down. So I think
that's a real direct hedge. It's just not the same thing. They're just not equivalent. And the idea that because something did poorly in a disinflationary or deflationary environment means it's going to do well in an inflationary environment just doesn't hold water. And yeah, I'm not going to say that.
Max, I think, though, in order to say that gold has been a bad inflation hedge, you'd have to find a period where there was high inflation and gold did not perform well, right? Because you're right. It's about when the phenomenon against which you're trying to hedge, when that happens, does it work or not? And tell me your evidence for why you think gold has not been an inflation hedge. I'm struggling to think of a better inflation hedge.
It's that there are better inflation hedges. Is that I encourage people to go watch the video with Michael Cow where he talks about the correlations, and it's all laid out there. What performs the best during periods of inflation, and it's oil, which is a OPEX commodity. That's what it is. It's an OPEX commodity. It's not that gold doesn't do well. It's that it doesn't do as well as other assets. And so it's touted as this king asset in the same way that Bitcoin is touted as this king asset that always does well. So it's not that it doesn't perform. It's that it isn't the best, and it is sold as the best. And that's what I'm challenging, is this idea that it is the king of inflation hedges, which it is not.
Here's the thing, though, Max. How would you buy the oil? Are you going to buy an oil mining company? Are you going to buy an oil future? Or are you going to be like Dan McMurtry and buy physical oil and take physical delivery in your house? You can keep a gold bar or a slick of gold in your sock drawer. Pretty hard to store oil that's quite corrosive. And you say, oh, you'll buy futures. But there tends to be, contango, an upward sloping curve.
But there's not. There's not.
Not now, Max. Not now.
Yeah,
correct. It's in backwardation now.
I mean, look, it's backwardated. You can buy energy equities. Like, there's a million things. I mean, I'm not pitching the perfect inflation trade here, but I'm not telling you that it's gold bars in your basement. I'm definitely telling you that it's not that.
I am by no means a gold bug. Max, if you were to ask me, not as a journalist, but as someone who actually takes a view about a certain asset, I would agree that oil is where it's at right now, and not gold. I'm just being a little bit. I'm digging in. I'm poking you a little bit. But Max, sorry, what are you gonna say?
No, I was gonna say to the audience, like, Jack and I are very good friends, and this back and forth is how we actually talk to each other. We have this sort of spicy back and forth going. So this is not we are not in combat here. If anything, we are in combat, but it's a friendly spar. Not
exactly. I don't want to see any comments saying like, man, Max and Jack really don't get along. Like I saw some comment. It wasn't when you were on, but I was talking to Ed or Ash, and I made some joke about like, oh, Max is sleeping in the office or whatever, or Max lives downtown. And it's just just a dumb little remark, and someone's like, man, Max really got it in for Max. So I do not.
Yeah, we do not. So no, but I mean that's how I feel about inflation. Look, I mean, oil is Brent, which is oil. I know a lot of people talk about WTI, but Brent is like the global benchmark, is up above 70. That's the highest correlation. We've got CPI print. I mean, it just keeps running. We've got, lumber is cooling off. Base metals are cooling off a little bit. So you could see some surprise downwards, but I mean, that's where it's at. That's where inflation is at. And yeah, it's not easy. It's not the same thing as buying this piece of metal. That's why people tout it as the king asset, because it's easy to buy, but that doesn't make it the best.
Yes. And I would say one argument that Raoul was making for Bitcoin over gold when Bitcoin was back at like 10,000 was that if you want 5x returns, you're crazy if you think you're going to get it in gold. But in Bitcoin, it's possible. And I think that was true. Max, I want to move on, though, to a question from Dean, which is a perfect question for us. Dean asks, what does Max or Jack think about option collars on meme stocks like BlackBerry or AMC? And my first response is, Max and I don't really know them as collars. We know them as risk reversals or riskies, because our friend Imran Laka, the options trader, gave us a private lesson one weekend, and he taught us all about riskies. So he's asking about a collar or a risk reversal, which is when you own a stock and then you sell calls to buy puts on it, to sort of protect your position. So Max, what do you think about that?
On stocks like AMC or BlackBerry, I mean, if it's covered, that's fine. I mean, that's exactly what you're doing. You're capping your risk and you're protecting yourself from the downside. I would argue, though, that if in my case, I wouldn't really want to, I don't know if I would want to structure it that way. If I wanted to just if I wanted to generate extra income by selling the call, that would be fine. But you and I actually did something different. And this would be why I think the put isn't worth it, is that it's very, very hard to realize the amount of volatility to the downside that is being priced into the puts. So Jack, you and I actually yesterday, or was it yesterday or two days ago? Wednesday.
2 days ago.
Yeah, on Wednesday, you and I both sold puts. So you would think that if you thought that AMC was going to cool off, you would want to buy puts. But I didn't want to get my face ripped off selling calls, but at the same time, it was almost impossible for it to realize the amount of volatility of the downside. So I sold a 15 and bought a 5, and so capped risk. I mean, you're capped, but I'm not allowed to sell uncovered options of any type.
Nor am I, Max. I feel like, are we kind of like Melvin Capital about advertising our short position? Are people now going to target us and try and? Are they going to do a short ladder attack?
No, I'm not too worried. But essentially, what I'm saying is like, what you're doing there is you're protecting yourself from the downside with this put, but the likelihood of it crashing that fast that your put has actually protected you in any sort of meaningful way in this case is so unlikely, because it's not like it's just overvalued. It's the volatility that led to it being overvalued. It's not like the famous collar trade is Mark Cuban in 2000, who he sold calls against his Yahoo, and he bought puts on the NASDAQ because he wasn't allowed to buy puts directly on Yahoo, so he did it through the index. But I mean, that was that wasn't a melt up that happened in 5 days, and the implied volatility spiked on Yahoo up to like 200. So that's why that trade makes sense, is because you were still paying a reasonable price. If anything, you're probably getting a very, very good price on those puts. And you were maybe getting a little bit of extra juice on the calls because there was demand for these out-of-the-money options, even though it's not even close to where we are now. I was 5, so I'm not going to hazard a guess, but I imagine that there was some out-of-the-money call buying in tech at the time too, and that probably drove up premium. So that's why that trade.
5, I was 3, and I bought calls. I did the same trade as Mark Cuban.
You bought calls. Okay, so yeah, that's why I don't think that trade makes a lot of sense.
Yes, I think there's a lot of merit there's a lot of reason to be attracted to selling calls. I think it is probably unwise. I think that the tail risk is on the right side. I think that everyone is just so foaming at the mouth and bullish about AMC for reasons that are perhaps not super rational. But the fact remains, as Weston says, it's about the flows. So I don't think that there's going to be a crash in AMC, and that, Max, is the only thing that you or I, as sellers of those long-dated puts, because they're long-dated, have to worry about is a true crash. Because if money just leaks out of AMC, the volatility is going to decline as well. And if volatility spikes, it is going to be, if we have, if it goes to $50 billion, and suddenly people are saying that, once again, AMC is some sort of act against the capitalist order, which I'm glad to see that we haven't seen so far. But Max, I want to move on to a story which I don't know if you've seen. Did you see the story about Pershing Square?
Oh yeah, how they're about to buy something and it went down?
One would think, based on the headline, Max, but it actually hasn't gone down. So Bill Ackman, a very famous investor, he's been very successful. He has a SPAC, and it's called Pershing Square Tontine Holdings, PSTH. And of course, all SPACs are issued at $10. Despite the fact that he had not consummated a deal, people were so confident in his ability to find a good deal that the stock, I think, was trading as high as $30, if not higher, at the peak in, say, about February. Before that, Max, there had been a lot of deals that almost fell through. He was going to make a deal with Michael Bloomberg. He was going to buy a slice of Bloomberg, which is a very high-quality business. He got rebuffed on that because Michael Bloomberg's like, I don't need your money. I've got money. And then with Airbnb as well, he tried to buy that. So clearly, Bill Ackman, he has good taste. He's trying to buy good quality companies. It's just that it's hard to be a SPAC when there are 2,000 other SPACs. It's just a.
He's doing it wrong. He's doing it wrong, Jack. He's trying to buy quality. That's the opposite of what you're supposed to do with a SPAC. You're not supposed to buy quality. You're supposed to buy crap. And yeah, I saw this actually earlier in the year when he raised the money. People were commenting that whatever acquisition he made was going to massively underwhelm because the bar had been set too high. And Not that I have like any particular insight into this specific situation, but I think it's really a good thought experiment for people to think about relative to just like how the market is an expectations machine, and that it doesn't matter whether something is good, it's about whether it's good relative to how high or low people's expectations are. And so if you set it at the ceiling for Bill Ackman when he raises a SPAC, then almost inherently it's going to underperform or not pop on the news unless there is some just incredible sort of acquisition. So I mean I look at it really more as a lesson or a case study.
Yeah, well, I did a little bit of research into the announcement and the announced deal. So Max, how about I sort of be the journalist, and you will be the person who's giving your hot take based on your wisdom, your experience, based on the information I'm giving you. I'll sort of be the analyst, and you'll be the portfolio manager. Okay.
Okay.
Okay. So the company that he is trying to buy a slice of is called Universal Music Group.
I'm familiar.
It is what some would consider a jewel asset. It's about a third of the entire music royalty business. And if you think the difference between music and movies or TV show is actually really big, because Netflix produces its own content, whereas Spotify doesn't own really any content at all. I mean, it may try and get the Joe Rogan show or whatever, but in terms of the big bucks, like it does not own Drake's library. It does not own Taylor Swift's library. That is owned by a separate company that then pays the artists. So there are three really big players. There's Sony, there is UMG, and then there's Warner. UMG is owned by a company called Vivendi, which is a French conglomerate. SoftBank actually tried to buy UMG earlier for $8.5 billion. Vivendi declined them. Tencent then sort of reached its arm and bought 20% of UMG. So currently that's how it is. Tencent owns 20% and UMG owns 80%. And investors in Vivendi.
Wait, how much does Vivendi own? You said UMG owns 80%, so it's 10, 10.
Excuse me, sorry. Tencent owns 20% of UMG. Vivendi owns 80% of UMG.
Okay.
What Bill Ackman is trying to do is buy 10% from UMG, even though UMG had previously announced plans to spin off UMG into its own public entity, which investors are really jazzed up about, because they're going to get they're going to be paid they're going to own that new thing, which they can then trade or buy more of, because they exactly, it was a problem because if you were super bullish on UMG, but you're like, Vivendi owns all this other stuff. They started as a water utilities company in the 19th century. They own they own the French version of HBO, which perhaps is very good to watch, very good French, but may not be the best business. But anyway, I was speaking.
I wonder what French HBO is like after midnight.
Yeah. There we go. Maybe a little bit something like the AMC CEO Zoom call, where he.
Well, get to it, Jack. Get to it. So, is this about the dual listing? Is this about the dual listing?
You mean the 3-part listing?
It's a triple listing. So enlighten me.
It's a triple listing. Yeah, I'm really just scratching the surface, Max. So, UMG is going to do a spinoff. That spinoff, the valuation is yet unclear, but currently it's about a $45 billion company, or slightly more, and 10 billion euros is assigned to everything that's not UMG. So it's valued at about $30 billion. And then it has a debt of $35 billion. The valuation that Bill Ackman is trying to get is $35 billion, including debt. So it's pretty much the exact. So what I'm telling you, Max, is that you can buy Vivendi stock, whether it's from French, in the French markets, or an ADR, and you could basically get the exact same deal right now, or on Monday when the market opens, that Bill Ackman is trying to get with this Tontine, or with his SPAC. So it shouldn't come as too much of a surprise that investors kind of were not thrilled, and I believe Pershing Square Tontine had a little bit of a crash today. I forget exactly how much it was down, but I don't know, somewhere around like 20%. So it's not looking so good.
So you're talking about like the ARB opportunity, like you get long Pershing now that it's crashed, and you short Vivendi. I mean, I don't know here. What's the play?
Max, I'm not thinking as an investor. I'm just marveling at this. And I really haven't even gotten to the structure. So 10% of Universal Music Group will be distributed to holders of the SPAC, but it will only happen after UMG lists itself via the spinoff. And then there's something called PSTH RemainCo, which has a forward purchase agreement and will continue to exist and search for another target. So there still will be a SPAC. However, it won't be considered a SPAC by the NYCE. And then there's the Special Acquisition Rights Company, or Pershing SPAC, not a SPAC, but a SPAC. And that will issue rights to PSTH shareholders to buy stock in the SPAC for $20, but only after it enters into a combination agreement. So this is going way over my head, Max. I really couldn't wrap my head around this. But it's when a hedge fund manager is inventing acronyms, and he's like, this SPAC, it's not enough. I need more. I need a spark. I don't know. I'm kind of flabbergasted.
I think that is the real innovation here, is the structure. It's not like the deal is any sort of fantastic deal or anything like that, but it's the way this is all structured. And I think if you've gone back and you've looked at any of the ways that people, the early investors into SPACs make lots of money, it's in being early and the structure of it. So, I mean, I would imagine that the way Bill Ackman is a very smart, shrewd investor. I imagine the way he has set it up with all of these companies benefits him and his backers very, very well. That's really all I can tell you about it. And anytime you get a complex deal like this, I mean, I'm sure there is some reasoning behind it, but color me a skeptic by nature, but I look at that and I'm just like, I can't imagine the fees. Look at all those fees.
Yeah, lots of fees. Max, I laid that out for you. That's what's on my radar. That's what I spent my time digging into today. What's on your radar? What are you seeing in this market? What are you thinking?
Well, I mean, so to be honest, that was like the first put I had ever sold. I never sold an option before. I'd pretty much stuck to the idea that like being long options is really the only safe way to be. So I mean, that was the big thing for me this week, was doing that, and I would just tell you that like that is super, super important. Like people all the time ask me about like, what should I read, or like, what do I think about this, or how do I get new information about trading? And I would tell you that just about anything that I have learned that I feel like really, really, really confident about, I've either spoken to a human being directly about it who knows it very well, or I've lost money on it in some way. And so like the best way to learn about a trade or structure and to understand how the profit and loss plays out over time is to do it. So like Dean, who was asking about like, what do you think about options on callers and meme stocks? Like I've got a pretty good understanding, but I bet you Dean would really understand it if he made the trade, and he'd understand it even better if he lost money. And so I say all the time, like the best way to learn about investing is $10,000 that you can afford to lose. So I mean, that's really what I'm focused on at this week was just that trade and AMC, and I kind of missed the first go around with the meme stocks, and I missed this one, and I wanted to experience some of this volatility, and I'm fortunate enough to be young and able to take losses in certain places, and I don't think I'm going to take a loss on this trade, but like that is the type of thing that I'm looking at. I actually see we got a question from Weston, our colleague who watched my interview with Brent Kachuba from Spot Gamma that I did for Zeros TV, which is Carson Block's channel. And he asked, like, what was your personal biggest takeaway or learning from him? And Weston, to answer you directly, is I was talking to Brent, and he told me the trade that he did, and he was saying like he sold 10 strike puts with no, he didn't buy the 5 like I did. So I sold the 15 and bought the 5. He sold the 10, and I think the stock was trading at 40 at around the time that he was doing that, and then it was up at 65 like a few hours later. And I just went like, when am I ever going to talk to like the guy at Spot Gamma? He's going to tell me the trade that he did, and then 2 hours later, the exact same trade is there, only it's like an even better trade. So like I gotta jump on this. I gotta do it now, and I could lose money. Brent could be wrong. I could be wrong. But those are the types of opportunities that, luckily enough, Real Vision affords.
Absolutely. I feel the exact same way. When I interview someone like Jared Dillian in February, and he says, I think it's time to go after Tesla. I'm short Tesla. And then you watch it go from 900 to 580. And then this stock has been the most impregnable stock. This is a stock that has humbled every single short seller in the entire world. Short sellers who've taken down Enron, who've taken down every single company, they've been humbled and made feel very mortal by Tesla. And then Jared Dillian in February just says, hey, I put my nose up in the air and it's going down. And then, not to mention, he and Tony Greer going along the oil trade, buying calls on XL, on Exxon. It really is great to be alongside people as they make these calls. And then when you see that trade not work out, that is very humbling for them and for them too. And that too is a privilege to sort of be part of that journey. I would add, Max, that we sold a spread. So we sold the 15s and we bought the 5s. Selling uncapped vol is really something that you shouldn't do unless you run your own hedge fund. So,
well, if you're selling a put, isn't it sort of capped at zero?
Yeah, like, because that's right.
It's capped at zero, so there is a cap there. It's just literally like my account is set up in a way that like I can't sell just one option. There has to be like another leg that closes it out. So I had to structure it that way. Jack, it actually kind of slipped my mind. So for the same reason that I think gold kind of looks interesting. Like I'm also I think the dollar could go lower, and we got kind of a pop in the dollar yesterday. It reversed today, but I still think the dollar goes lower, and it's because we're going to continue to be very dovish. I think we'll be dovish for a long time, and people. There's all this talk about inflation fighting and the Fed. Like tapering, and I just don't think that's going to happen. And so it's all about those surprises. And then so as they continue to be dovish, as inflation continues to go higher and we continue to be dovish, like those are the types of things that I like. And everybody's kind of calling for the exhaustion. A lot of people, it's not everybody actually, but a lot of people are calling for the exhaustion of this dollar slide. So I'm going to be selling dollars into bounces. That's the other thing I'm doing right now through UUP. So
buying puts on UUP.
Yeah, buying puts on UUP. Yep.
See, I'm more in if I had your macro view, which I don't know if I do as vehemently as you do. I don't think the dollar is going to 100 anytime soon, but I think we could be. I think what Raul says about just volatility is going to be very, very low. I don't know. I think I could be maybe a seller of call spreads for UUP.
Yeah, maybe. As I said, I just sold an option for the first time ever this week, and that might become my new bag. But for now, that's not my bag, baby.
All right, we've got a question from Prius Omega saying, do you have experience with options that have very low volume or very low liquidity? I'm literally the only holder of some options for SILJ. The price action on it is funny. Is SILJ the junior silver miners? Let me look it up.
Yeah, let me pull it up too. So not really, but what I would say, yeah, it's junior silver miners. Like I don't, and that's because I wouldn't do it for those reasons. Like I wouldn't want to be the only ones, but there is something to be said about like that's kind of if you want to get into things early, sometimes that has to happen. Now, to be the only holder of options on something, like I would like to see, like historically, that there was some options market in SLJ, like if it gets hot, like if it really starts going, that people would come into the market. So if you're right and it does take off, then you can go back and look and say, back in 2020 when silver really took off, okay, the options market did open up. And so you can do that, and you can get in early, and you're going to get, taken to the woodshed on the spread between the bid ask, especially if you're the only person there, and you're going to give up some. But if you're early enough and then people move into the market and you get a more liquid market later, like it's true in equities too. So I've talked to hedge fund managers who, that buy things that are like sub $50 million market cap that are trading like hundreds of thousands of shares a day. And what they said is like, yeah, if you're wrong, it's really bad. But like we make sure that we're highly, highly confident, because then it's harder to build a position. And then if you're right, then on the other side of it, there is liquidity. And so just make sure that when you are right, that there will be liquidity. But no, I generally don't do that. But I would say, as a caveat to that, I hear people say all the time, like, oh, that's too illiquid for me to play around in. Like, if you are like, and again, caveat that this is not true of everything, but like, if you have like a sub $100,000 account, or like, probably most stuff is liquid enough for you. Like, unless there's literally no option, no volume. Options is a different thing, but like I see people talk about it all the time, like, oh, there's not enough liquidity. Like, I think the most illiquid I've ever gotten into in the options market was something like, there was maybe like a little less than 1,000 contracts in open interest and volume in like the hundreds in a day. Like, I'm not trading hundreds of options at a time. Like, that's something I can play around in that. But to own the only ones, I don't know if I would do that.
Yeah, I think noting that liquidity risk is something that you do if you run $10 billion and you're like, oh, I used to buy and sell. I used to do long short in Austria, but now my hedge fund's bigger than the country. It's too big for the country. That's not a problem if you are playing with this type of money that. Yeah, go ahead.
No, I was gonna say, which I would add is where you find edge. Like, go back to, if you haven't seen it, it's a fantastic interview with Marcus Frampton on Real Vision, who is the CIO of the Alaska Permanent Fund. And it's a $75 billion sovereign wealth fund for the state of Alaska. And in his free time, though, he trades illiquid microcap stocks. And the reason, partially because there's no conflict of interest, there's no crossover between his $75 billion sovereign wealth fund and his personal account, which I'm sure, he's a successful guy. Like, I'm sure it's decent sized account, but his argument is like, one, it's fun, it's intellectually challenging and stimulating for him, but like, where are you going to have edge as an individual investor? And illiquid things, or specifically if they're illiquid because they're small market cap, like not like an options trade, but there is some edge in illiquidity if you can manage it, if you have the structure to be able to manage that. And if you're a small investor, then yeah, you can manage that sort of thing.
Yes, I think that someone running a $75 billion fund and then trading microcaps in their free time, it kind of reminds me of.
And not just microcaps, like pink sheets. Like, these are the types of, like if you've seen Wolf of Wall Street, they talk about the pink sheets. Like, these aren't just like, oh, it's on the NYSE, but it's small. These are like, they only trade over the counter. Yeah.
Yeah. Aerotime International. So I was going to say, it kind of reminds me of Warren Buffett, like, managing hundreds of billions of dollars, but he plays bridge. He plays online bridge under the name T-Bone. So it kind of reminds me of that.
Actually, my uncle got to play with him. He was playing bridge on a site and had like a bad experience like with some people, and reached out to the company to like complain about it. And Warren Buffett like said, like, let's play online bridge together. So, truly a class act.
Truly. Well, Max, we're approaching 5 o'clock Eastern time. Pretty soon, I think we should let everyone get started with their weekend. Anything you got to get off your chest before we get into the weekend?
No. I just hope everybody in Miami is being safe. Have fun. And Jack, this was a lot of fun. I look forward to getting to do it again soon. And thank you to all of the audience for the questions.
Yeah, everyone in Miami, be safe. Don't use too much leverage. Don't get too crazy. And I'll see you guys on Monday. Take care.
Bye-bye.